Hello, everyone. This is Sebastian McMahon from IA Financial Group. I'm back with another weekly economic review, this time for the week ending May 13, 2022. So it's Friday the 13th and the markets are pretty red. So here's the pun of the day. So this week was positive for bonds because of the risk of sentiment. So it's a good thing to see bonds reacting positively to a sell-off in the stock market. So 1.16% for the universe index and plus 2% for the long index. But if you look at equities, lots of red everywhere, minus 4.44% on the TSX. The Canadian dollar depreciated, meaning that it helps the return on foreign assets held by Canadian. So the TSX actually underperformed in Canadian dollars, the S&P 500, but the Nasdaq was down between 5 and 6%, depending on if you're hedging or not. So a very, very tough week here for equities. The price of oil was down on the week, Canadian dollar too, and the price of gold down strongly. Now we're negative territory year to date. So we had some interest for gold at the beginning of the year. Price went up, and now we've given back here all of the returns year to date. We've stayed away from gold since the beginning of the year because we it's not really making sense to us how what the role of gold should be in our portfolio right now. So we're staying away. So no harm's done here in our portfolios. So I'll be focusing on the stock market action this week because we're on the verge of a bear market on the S&P 500. And a bear market, the definition is a pullback of 20% since the recent peak, and now we're at minus 18% for the S&P 500. So we're almost there. And this week we had the inflation figures in the US that did a lot of the damage to the risk sentiment of investors. We had inflation coming a bit lower from 8.5 in March to 8.3 in April. So a little bit of a pullback. So seeing the peak is in, but month over month for core inflation, so we're talking about food, talking about shelter here, it's accelerating pretty broadly. So more economic damage to the wallet of US consumers. So this is not seen as very positive. And Mr. Powell on the Fed chair yesterday on Thursday said that they're a bit less convinced that they'll be able to engineer a soft landing. So probably there's going to be some economic damage from hiking rates. And they did repeat that probably they will be coming with a 50 basis points hike at the next two meetings. So we're not on the verge of seeing a Fed pivot here. So the tone is pretty downbeat in equities. But as I'm recording this Friday morning prior to market open, futures are pointing higher. But we've seen lots of intraday volatility this week. So let's see where we end up. But if you look at the damage done, so here you have the drawdown for the Nasdaq on the left and for the S&P 500 on the right. So Nasdaq's in bear market territory. It's been in bear market territory for a few weeks now, minus 30% from the peak, which was in last November 2021. And the S&P 500, the peak was on January 3rd this year, and now we're at minus 18%. So we're on the verge of a bear market. If you look outside of the US, well, here on the left, you have the global ex-US index. So everything in the world except the US, we're at about minus 16. So we're not yet in bear market territory, but we're getting close. The TSX is a bright spot. It's outperforming to the downside. So minus 11% year to date for the not year to date, but since the recent peak on the TSX. So we're further from bear market territory than in the US. So it's outperforming the US, but to the downside. Nowhere to hide because, as we've mentioned many times this year, bonds have been suffering. So the drawdown, and here what we did is that we took the ETF, the XBB, which is an ETF that you can buy, and it's benchmarked to the Canadian, the TMX Universe Index, and we're at about minus 13%. So the damage done here. The good news is probably that we could start to see maybe opportunities to invest in bonds. Rates are higher. Maybe a lot of damage is already in the books. In our portfolios, we started adding to our bond exposure. We're still underweight, but much less so than before. Slowly but surely warming up to bonds. So let's see how the markets behave over the next few weeks. But the good news is that the relationship between stocks and bonds, at least over the last few days, reconnected, meaning that if you have a strong pullback in equities, you have a gain in bonds. So that's good news. So let's see if it moves forward, but staying prudent, not trying to time the bottom. That's the thing to do. So we could do a whole series of weekly reviews about the technical indicators that we look at to time the bottom of markets. So I'll be covering that in the next few weeks, that's for sure. But right now, we don't try to time the markets. We remain underweight equities. We remain slightly underweight bonds, but we're warming up to bonds, and we're staying the course, and we're staying nimble. So when we start buying, when we think that probably we have a strong foundation, we'll let you know. We'll share the indicators that we look at. But right now, trying to time the bottom, it's not investing, it's gambling. So I would strongly recommend against doing that. So what does a typical bear market look like? So here's a table. So you can pause this video and take a look at it in more details. So we went all the way to 1957, and we included also some markets where we were just about in a bear market. So when we touch, like, let's say minus 19% plus. So to have a larger sample here, because I know in 2018 we almost had a bear market. We had one intraday, but not the usual definition is that the market needs to close down 20% from the previous high. So those when we were on the verge, that still gives you an average decline of minus 29%. Now we're at minus 18. So if we do go into bear market territory, well, there's still about 10% downside before we reach the average. So it's not a law of physics, it's just an historical average. So, but it's a guide. So probably if we do go there, there's more damage to be done. The typical bear market lasts about 322 trading days of going down. This time it's only 90. So the figure for as of the close yesterday is 90 days that we've been going down since early January. The last few bear markets were much faster and swifter than that. So maybe now things will take less time. It doesn't mean that we have, like, 200 some days of downside to go, maybe, but I think it likely not. But the good news is that if whenever we find a bottom in the markets, then when you look on the right, the number of days and of upside that you can have after that, it's actually pretty long. So when you have a bear market, usually you just reset everything in the markets, and that gives us a strong base for long-lasting returns. So the usual upside after a bear market is 1.6 years. So there's a lot of potential after that. So the idea is to manage risk on the way down, not try to time the bottom, but when you see a strong foundation, and we'll share, as I said, share with you when we think that is in, why we think that is in, and when the time comes, being overweight equities and just surfing the wave is going to be a very interesting strategy. So yeah, so that's where we are now for the markets. I think it's the first time in these reviews that I've talked about crypto explicitly, but this week we had a few things happen. So I'll start talking about that right now. Crypto, so what goes up must come down. And when we hit COVID and there was a lot of fiscal spending, so sending money to people, what did they do with that? We know that a lot of that money went into crypto and in technology slash NASDAQ slash ARK kind of strategies. So we know it went there. So the hot money went there, and that's an indicator for us when the money is when we see that this bubble has completely deflated, and we're seeing the hot money that has completely come out of that, that's going to be a good sign that maybe there's a bottom on risk sentiment. So on the left, you have the price of Bitcoin. It was at about $10,000 when COVID happened, so in early 2020. And we hit almost 70,000 in 2021, or at the end of 2021, early 2022. And now we're at about $25,000-$30,000. So a lot of damage has been done. Would love to see some more damage in there before calling a bottom in risk sentiment. There's probably more room to run, because a lot of money went there. A lot of money also went into the NASDAQ. I showed you earlier that the NASDAQ corrected by 30% already. could see some more damage. And the chart on the right is very important. The correlation between the price of NASDAQ and the price of Bitcoin is as high as it's ever been. So it's the same crowd trading the same thing. So that's what it means. I mean, both assets behave in a very similar manner. So you want to see a flush out, a complete flush out in these two markets before you can say that maybe risk sentiment has bottomed. So that's become an indicator for us. So that's point one about crypto. Second point here is new asset classes are riskier than one might think. And we were asked the question very often about when will crypto appear in our funds? When will IA offer crypto funds? It's still very early for that, and we had a good example this week. So many things happen in crypto world this week. I won't cover everything because I'm not the expert, and I mean that's not what I do. But this week we learned that the Coinbase platform. So Coinbase is a platform where you can trade crypto and host your portfolio. So you put your portfolio there and you trade your cryptos with Coinbase. Well, Coinbase this week, seemed everyone realized that Coinbase wrote this like black ink on white paper that users could lose their crypto holdings if the company goes bankrupt. And the stock, and just to add to the effect here, here's the stock of Coinbase on the bottom left. It's not going in the right direction. So just remember that if you use traditional assets and you have money in the bank and you have a brokerage account, well, there are some protection for you. So there's the CDIC that's there. If you're in the province of Quebec, some institutions are covered by the AMF, the Autorité des Marchés Financiers. So they're there to protect you, to protect your savings, to protect your capital, and eligible deposits are automatically covered to a limit of $100,000 per insured category per financial institution. So you're protected if you use traditional assets in a bank. If you want to go into the alternative and you think crypto is the way to go, well, when crypto goes up and when it just goes exponentially higher, that's a lot of fun. But what it crashes down and it takes the business model with it, and you have some bankruptcies and you lose all of your holdings because the platform is in bankruptcy, then that means that there was some credit risk or some counterparty risk in that you didn't think that you had. So very important to keep that in mind, that new asset classes, it's fun when they go up, but there's more risks that are hidden in there than can meet the eye. And it's important to know exactly what are the risks when we invest. And just a reminder that typical asset classes, there's some protection there for you. So just wanted to cover that point. I think it was a very important one. So what to watch next week in Canada? We'll have CPI inflation. We had 6.7% in March. We'll have the figure for April. In the US, March was the peak so far. So we'll see if that was the case in Canada too. And housing starts are going to come out. In the US, we'll have retail sales, we'll have housing starts, industrial production. So a very full economic calendar. So that wraps it up for the week. If you want a PDF copy of this presentation, you just go on LinkedIn, search for my name, and I'll be posting that. I always post that on every Friday morning, so it's going to be there. Economy and Finance 101, there's some new material there if you haven't checked it out. And Twitter and LinkedIn can follow me. And through the week, I'll be posting my thoughts on these platforms. So thank you. It's always a pleasure to serve you, and I'll be back again next week with another edition of the Weekly Economic Review.